Hey everybody, back with another dividend analysis, and today we're going to be looking at Conagra Brands Inc., or very simply CAG, or CAG. Wanted to look at CAG because, as you all know, I really like consumer staples when it comes to dividends, and this is a pretty well-established consumer staple company. So without further ado, let's get into it. As always, we'll start by looking at the yield, currently sitting about 3.75%, and not too shabby, doing 2 to 3 times what the wide market is doing, so you're getting a very nice yield from a very stable company in a very stable sector of the market. Looking down at the dividend history, we can see currently getting just over 31 cents a share, and if we go back to 2017, we can see increases, a bit of a stagnation here from 2017 to 2020, but we've gotten 2 raises since then to 27 and 31 cents. However, note that there was a dividend cut at the end of 2016, beginning of 2017. However, they started raising the dividend again immediately. Not sure what this is from. Do a little bit of research. Might have been some kind of spin-off, something like that forced that free cash flow down. Probably why that happened, but do some research. However, before that, we can see that the dividend was pretty stagnant at a quarter per share from 2013 to 2016. So not a ton of dividend growth until very recently, so just keep that in mind going forward. Now let's see if they're able to pay that dividend. Doing the math, Conagra does about 600 million in dividends per year, so we'll have to be able to do more than that to be able to support said dividend. Going down to the cash flow, we can see that cash flow over the past 5 years has been pretty stagnant, going from 900 million up to 1.5 billion and back down to 900 million, so very stagnant in that regard. Technically up very, very little, about 3-ish%. Nothing crazy, but it's been very, very flat over that period. If we do our math there, we can see that our ratio of free cash flow is about 62%, not ideal, but definitely below that acceptable range of 72%. And since this is such a mature, well-established company, you're really looking for most of your reward from holding the stock to be in that dividend. There is going to be, of course, a little bit of growth when it comes to, inflation, GDP, things like that, but this isn't a company that's going to explode in value. You're really looking for that dividend as the way to be getting rewarded for holding that share, as opposed to capital appreciation. Now, looking over at the income statement, we can see that income, however, has gone up very nicely over the last 5 years, almost tripling, going from $500,000 up to 1.3 billion, relatively steadily, with just one little drop here, going up from 8 down to 7, back up to 8.5 or 850 million. So again, very nice, good, steady income growth. However, you would like to see that income growth and that free cash flow growth kind of coincide. So there's probably a lot of things in here, write-offs, depreciation, stuff like that, that's making the income look different from the free cash flow. So you might want to look into that, see why it's so different from the free cash flow in that regard. Doing our math here, we can see that we're getting about 46% of our income paid out as dividends, which is very nice, well below that 50% range. That means that more than half of the income they make is not being used for dividends, so that's very good. Dividend is relatively safe. Even if this 1.3 fell down to about 1 billion, or maybe a little bit below that, if it matched up with the cash flow, they would still be very much able to pay that dividend, maybe even still get small increases in there. So that's very good. So what does Conagra do? How are they making this money? You probably have some of their products in your home, or you've walked by them without knowing it. They do prepackaged foods, things like stuff in the frozen aisles, stuff in the pantry aisles, prepackaged food. If you've eaten something that is, non-perishable or something frozen, you've probably eaten their stuff at some point in time. And again, this is a very, very stable, very consumer staple, not exactly depression or recession resistant, but they aren't a company that's going to go out of business just overnight. It's really going to take a protracted decline, mismanagement, something like that. This is a company that's going to be there just because people have to buy food. It's something that's going to happen. So if you're looking for something with a little bit of stability for your portfolio while still being a dividend, I always say consumer staples are a pretty good thing to do that. Now looking at if you actually want to have it. From the appreciation side, it's a little bit iffy as we go back and look. We do have some appreciation over the last couple years, but of course we had a dividend cut, have to do some research into that, always a little bit of a red flag. And we've had a lot of stagnation here with 25 cents for a few years and then 21 cents for a few years. So it's very iffy in that regard. I'd really want to see another increase or two before I really called this any kind of dividend appreciation. So just note that. From the yield side, not too bad. Almost 4% in such a low yield world. Nearly 4% is a very good yield, and really it's about run-of-the-mill for your consumer staples. A lot of A lot of grocers that have yields are really sitting in that 3 to 4% range. A lot of consumer staples that are considered higher yielding are in that 3 to 4% range. So, this might be something. Again, it's going to be hard for them to go bankrupt unless something terrible happens, something to the company. The wide market, it should be able to survive just because people need to buy their products. So it's unlikely that they'll go bankrupt because of something like that. So yeah, if you're looking for some kind of stabilizing force in your portfolio, again, this is a large cap company sitting at a $16 billion market cap, very stable, very mature, old company. Again, a very stabilizing part of a dividend portfolio, a decent yield, probably not going to see a lot of capital appreciation, but something that can keep your portfolio okay in those dark times while still giving you a little bit of yield. As always, thanks for watching, and I'll see you next time.